Hi everyone, Tim Knight here. Let's talk a bit about the market, shall we? First up, I've got the 120-day hourly bars of the euro slash US dollar cross. As we can see here, the drop late in January was a big aid to equity bears. And the drop we've seen, much more dramatic of a drop over this month here, likewise pushed the equity market down. And what's going on in this region is an attempt to set some kind of base. There was a little bit of a sneak below there, I guess yesterday, but in any event, there is a base trying to be formed here, which is why the only big long position I've got is FXE, which hopes to benefit from any push up in the euro. Now, as far as the S&P, the bad news here is that this has become kind of a mess, and then that's what's really exasperating to me, because what we've seen over the past 6 weeks or so is this nice stone pattern, nice falling away from that, the famous fat finger crash here, which actually was a very nice tipping of the hand as to the market's ultimate price in a couple of weeks hence. Anyway, with the little crash here, very strong, hardy bounce up, just about up, but not quite to that neckline. And then, most wonderfully of all, this nice sustained waterfall, big down, little up, big down, little up, and so forth. And as with the euro, it's been trying to find a base. Now, until just really a couple of days ago, this was a very clean, easy pattern to follow. And what I had been anticipating was the culmination of the inverted head and shoulders target, pushing this to somewhere in this vicinity, 1130 or so, maybe as high as 1140 or thereabouts, this region. That didn't happen. The pattern completed, started moving up, and got wiggy on us, and then started moving down, and then today rallied pretty hard. And so this pattern as a measuring tool is just moot at this point. I don't think that has any use to us anymore. And looking at this whole region, it's very tough for me to read what is going to happen subsequent to this. I mean, I do think that this line here still represents profoundly formidable resistance, but that's a heck of a long way. I mean, that's almost a good 4%, even after today's very hardy rally from where we're at right now. Looking at individual equities, though, what seems pretty clear to me is that whatever kind of bounce we get, either big or small, it'll be relatively evident on a stock-by-stock basis when a good time would be to get serious about shorting again. Now, for my own portfolio, I still have a bunch of shorts. I actually spent the morning covering a portion of them, but I still have a lot of individual shorts. I don't have any large single short position. In addition, I acquired a dozen long positions. These, by and large, are energy positions that have just gotten the life beaten out of them. I'll zoom this into a 1-year graph. And these are just bounce plays. Most of these, as I say, have just been hit very, very hard. They're not necessarily all energy plays, but out of the dozen, there definitely tend to be more of those than any other. This is a pretty clean pattern here, especially with the volume boost. There's FXC, as I mentioned earlier. This is a nice range play between 10 and 17. This one is just a good clean breakout. U.S. Airways, for reasons unfathomable to me, is just doing sensationally well. So that's here's Las Vegas Sands. And back to some energies here. Things that have lost about half their value in some cases. And then finally, I waited on this one. Rig, clearly a victim, so to speak, of the Gulf disaster. So, taking in the most extreme form, if so many energy stocks look like this, I think that under the most optimistic circumstances, there's just no way that these guys are going to get past this area where they broke down. So for longs, that's substantial, because that's a good 40% plus from where we're at right now. So if these do firm up, there's some very dramatic percentage gains to be had. But whether it goes up 5% or 45% remains to be seen. That's going to be kind of news driven. But clearly, these are very, very badly stretched down. And by any measure of these, as far as target prices, those have been exceeded on the short side. So I did lighten up earlier today as to the energies and actually went long a dozen of these. I've got sitting in the wings a 100 really cool stocks in my bear pin that I'm going to kind of hold back on until we see some kind of meaningful bounce. I don't think I'm going to trade much tomorrow, that is Thursday, because all eyes are on Friday's jobs report. It's kind of old news now in terms of the census hiring is going to make the jobs figure appear terribly impressive, but people will quickly look beneath the surface to see, setting aside all those temporary census workers, what's the real jobs picture look like. So it's pretty plain that tomorrow's a very light news day. I think that Friday morning the jobs report is going to be the catalyst and the driver, probably for some days to come in terms of direction. But as far as things stand now, we're in a bit of a no man's land. The indexes aren't really high and they aren't really low. They're just kind of in that challenging middle. And so I've kind of taken the foot off the pedal to some degree, and am anticipating getting more dedicated to getting short subsequent to some kind of bounce. Some indexes are more vulnerable than others. The utilities here is already kind of prone to a fall. I'll close by saying that I've mentioned a couple of short positions in gold and then GDX, and those I kind of take on a day-by-day basis, but those are kind of intriguing. It's interesting to me that silver, for example, fell and gold fell today, although most assets had a very good day. So not a lot else to say right now. Let's just I'll kind of wait for Friday morning, and that'll give us some more enlightenment. Good night, and thanks. Bye.